Good afternoon, everyone. Thank you very much for joining us today. My name is Patrick Ray. I am one of the advisors here with the Retirement Group, and we appreciate your attention this afternoon. Today, we're going to talk about some updates at Chevron and what's happening with the interest rates and some things that you probably want to stay on top of if you're considering leaving the payroll. And before we get started, there's a few things that I need to cover with you. First and foremost, it's important for you to know that we are a completely independent retirement planning and investment firm, and we have no affiliation with Chevron. We have no affiliation with Fidelity. And basically, our experience comes with the folks that have come to see us or we've helped who are in similar positions as yours and try to help them transition into a successful retirement. And one of the tools we utilize in an effort to do that is this webinar platform where we talk about things that are certainly current and relevant and things that you want to put on the forefront if you're considering retiring at some point. And so in the event that you have not been at one of our webinars before, welcome. But if you've been in the past to our webinars, you'll also see an access to, in the chat, links to give you some of the recordings we've done in the past so that you can peruse some of the things that might be relevant on different topics at your own leisure. Now, you also get access to the webinar libraries and the ebooks libraries, but most importantly, what you'll find most relevant is the cash flow analysis that we do, which is a complimentary service to help you stress test where you're at from a retirement planning perspective and to see if you're on track to meet your overall goals and obtain a successful retirement. And so hopefully you'll find some value in what we have to talk about today, and I'll bring on my partner, Tyson, to talk about today's material. Tyson.
Thank you, Patrick. Thank you, folks, for attending our webinar series this afternoon. My name is Tyson Mavar, one of the Chevron-focused retirement advisors for the Retirement Group here in Texas. And today we're going to talk about the current environment. As Patrick mentioned, some of the implications of interest rates on the lump sum, but also where do we go from here? How do we use the information, what we know about what's happened in the last couple of years? How does that apply to your retirement plan? And what are some things that we can do to increase the probability of success in retirement? So we're going to discuss that a little bit today. Those of you who aren't as familiar with this, the Retirement Group's been around just over 30 years working with corporate employees, and we've worked with Chevron employees specifically for over 2 decades. We have many clients from Chevron. We have gone through the process of helping people put together retirement plans for quite some time, and we're very familiar with the retirement benefits and retirement process at Chevron. So some people have found this to be important in who they choose to work with as a retirement advisor, because they know that it'll give them confidence that they're not going to make any mistakes and that they were working with somebody who's gone through everything that they're going through in terms of creating a paycheck after they leave the payroll at Chevron. So I encourage you to spend some time with us on a one-on-one basis if you have not done so already, or if it's been a while since we've updated your plan or had a chance to talk about your retirement plans. Let us know so that we can update your cash flow analysis at the very least, and hopefully spend some time on either a web meeting or an in-person meeting to go over some of the current issues that are happening and how they might impact your plan. Also, here's a QR code that'll give you access to our LinkedIn page. I encourage you to follow us there if you're not doing so already, because that's where we publish our videos like this one on a variety of different topics related to Chevron retirement strategies. So here we are in 2022. We've seen unprecedented levels of government spending, as well as unprecedented levels of monetary policy stimulus and very low interest rates. Now, while that's been good for those that are retiring or maybe left during the offers that we saw a couple of years ago, because lump sum payouts were at historical highs, there's some problems that we foresee going forward as a result of the higher government spending and the lower interest rates that we have seen in an effort to stimulate the economy in the last couple of years. And so what does that impact of retirement plans? Well, one of the impacts of higher government spending and lower interest rates is inflation. We already saw that in the highest inflationary environment that we've seen in 40 years last year. And we anticipate that not to stop immediately. We've already seen some higher interest rates that are a result of higher inflation. That's part of the directive of our Federal Reserve, who makes our monetary policy, is to not only maximize employment, but to minimize and manage inflation. And one of their policy measures to do that is by allowing interest rates to start to go back up. So we've started to see that already, and we'll talk about that in just a moment. But we also have perspective on how you should build your retirement plan as a result of the likelihood of higher inflation and higher taxes going forward. And Although that can erode our money in retirement, we have some recommendations on how to navigate that as you build your investment portfolio and as you build your retirement plan. But let's go back to the interest rates. Many of you know that the lump sum option on your pension plan is a function of current interest rates. And what we're looking at here are the interest rates published in the last 3 months, February, January, and December. And as it turns out, there's 3 different interest rates they follow, which are based off of short, intermediate, and long-term corporate bonds. And then they take an average of those 3 months, which as it turns out are the 3rd, 4th, and 5th month prior to the month that you are taking your pension, not necessarily the month you retire, but the month you take your pension. So right under here, you can see the May 2022 blended rates. Those are the average of these 3 rates above. That's how May was calculated. April was calculated based on November, December, and January. So it's this running total. And unfortunately, they change so often that we cannot predict that far out into the future. For example, ExxonMobil, we also have some clients from where they take a quarterly average and those rates are good for a quarter. It's a lot easier for ExxonMobil employees to pick a good time to retire because they know more about the future. Whereas if you work for Chevron, these rates will slowly eat away at your pension in a rising interest rate environment. And although we can't predict the future of interest rates, we have a good feeling that we're in a pretty low interest rate environment now. And we already know that if you can look here, March versus May, interest rates have already gone up just 30 basis points to May, but they've gone up 60 basis points if we look at the current interest rates in February. And this is not good for people that are planning on taking a lump sum and who are not able to retire as soon as this year. Now, if you're close to retirement or maybe have a consideration to go work somewhere else, leave Chevron. This could be a good time to consider leaving Chevron to get the most out of your pension plan. Also have the ability to reinvest those assets in an IRA potentially, or maybe even your 401k, and then go make some income somewhere else. But to lock in the maximum benefit payout on your lump sum, this is the time to be considering this. And unfortunately, not everybody's going to be able to do it, but we strongly encourage you take us up on the offer to run that cash flow analysis, because not only will we look at where you stand today and how sustainable might your retirement plan be given the conservative assumptions that we make, but we're also going to help you do a cost benefit analysis of different retirement dates so that you can know the different implications of different retirement dates and the risk of staying at the company, as well as the risk of leaving the company too early. And everybody's different as it pertains to these different decisions. So take us up on the one-on-one conversation if you haven't done so in a while, or if you've never done so, certainly. Now, what do we do at the retirement group? Well, we help people retire in the most tax efficient and sustainable manner possible when they leave Chevron, but then we actually manage retirement assets for Chevron employees and a variety of other corporate employees around the country. And how we do that is a little bit different than some of our peers. Fidelity, Vanguard. We happen to use Charles Schwab as a custodian for our clients' assets, but we're also even independent of Schwab. And our philosophy is to protect against the risk of permanent loss of capital in a retirement plan. And we do that through a value philosophy that we're going to talk a little bit about today. Now, value investing is about buying stocks as if we're buying companies, because that's literally what we're doing. We're buying businesses. We're just buying small pieces of various businesses. Now, we want to buy good companies, but we also don't want to overpay for those companies. So how do we figure out how to do that? Well, we look at the fundamentals of a company. We'll look at different ratios, such as a price to book ratio. That's the cost of a share of stock relative to the book value, or the value of the assets minus liabilities in a company. We also look at the price to earnings ratio, PE ratio. It's the cost of a stock relative to the profits of the company. We look at the dividend yield, but as it turns out, as value investors, this is not the utmost importance to us. You've seen examples in the past where solid companies have overpaid in dividends, and in many cases borrowed to pay a dividend that is unsustainable, and they're actually eroding shareholder value to do that. We might prefer that a company buy back their own stock rather than pay out a dividend, or use the free cash flow for better investment opportunities. One stock that I particularly like and this is not necessarily a recommendation, but Berkshire Hathaway, a company that's returned over 20% per year for over 55 years to investors, has never paid a dividend. And what their manager, Warren Buffett, has said, if our shareholders need cash flow, they should just sell shares rather than expecting us pay a dividend. So while dividends can help, especially in the low interest rate environment we're in today, where fixed income and bond investments aren't paying a lot of cash flow to replenish the retirement accounts that our clients are pulling from constantly, we may use shares and selling stock or bonds to produce cash flow rather than purely relying on dividends and interest of those bonds. We also like to identify great money managers that not only have a great track record of managing assets, that also eat their own cooking and have a vast majority of their own net worth invested in their companies or their funds. That gives us a show of confidence that they have conviction in their ideas and their ability to manage investments. And our number one goal is to mitigate the risk of permanent loss of capital. And we do that by buying assets, not just stocks. You can think of your real estate investments through this philosophy as well. We're buying with a margin of safety. If we buy a company on sale relative to its intrinsic value, not only are we going to get to capture more of the upside on the recovery, but we're also going to have less risk of losing money because we bought that stock on sale. So we look at all of these different things, but first and foremost, we look at buying a stock like we're buying a business. And for producing cash flow in retirement, when we're buying stocks, we typically want to have a long time horizon because we cannot predict the short-term fluctuations of the market or any individual stock. So we can't have all our money in stocks either. And that's what building a well-allocated portfolio should be the directive and the job of your financial advisor when you leave Chevron. Now, today we're in this inflationary environment that has, we've seen several of these in the past, but has different implications on different types of stocks. So let me zoom into a chart where we're looking at growth stocks in blue. And this is just a generic index fund that tracks growth stocks, which are high multiples of earnings. They cost more relative to the value stocks, relative to the earnings that these companies are producing. Now you've seen there's been a major dispersion, or a major, especially in the last decade, there's been a overperformance of growth stocks relative to value stocks, more than there's been in a very, very long time. This chart only goes back to about 2001, but this dispersion was also seen in the late 90s, where growth stocks, mostly internet companies and tech companies in the late 90s, performed a lot better than value stocks on average. And that was because they were very popular. And that's typically the case with growth stocks because many of them do not have current earnings or do not have earnings that would justify their current stock prices. And that's what we've seen in the last few years. Now, 2021 was an exception to this, where that is also not shown on this chart, but value stocks have started to see what we call a sector rotation, where value stocks are starting to outperform growth stocks. Now, we cannot predict when these sector rotations are going to happen, but what we found is that historically, value stocks do a lot better than growth stocks in inflationary environments. Now, why is that? Well, how in part we figure out how valuable a company is by discounting their earnings in the future. And growth stocks typically do not have as great of current earnings, but we have a prediction that they're going to grow, they're going to become more popular, and their earnings are going to be out in the future. Well, when interest rates are higher, as it turns out, the discount that we put on those future earnings are also higher, which means the price of those stocks are typically going to go down. The growth stocks that have valuations based on future earnings are going to go down faster than value stocks. And we've seen this time and time again in inflationary environments. Value stocks outperform growth stocks. So not only would we prefer to invest in value stocks just in general, we prefer to overweight them because historically they've done better than growth stocks, but especially in an environment where growth stocks have outperformed value stocks for quite some time, we see just a much safer and better growth potential in value stocks right now. And this is what we're overweighting in our clients' portfolios, not only to make more money and help to fight inflation over the long run, over the course of everybody's retirement, but also to protect first and foremost against permanent capital impairment, or essentially losing money in retirement. Now, you're always going to have volatility and fluctuations in stocks. That's just goes with the game that we play in buying stocks. We can't predict what's going to happen in the short run. But like Benjamin Graham said, the stock market is a voting mechanism in the short run, but a weighing mechanism in the long run. And what he meant by that is that it's a popularity contest in the short run, and we might be buying a company because it's popular for no rhyme or reason relative to the fundamentals of that business. That's what we want to avoid as value investors. We want to buy companies that are great companies and we expect to be around and profitable for a long time, but we never want to overpay for those companies. Even if we love the company, we want to only pay a reasonable price, or maybe even a great price if we can find it. Here's another example of, you see sector rotations where in green you see value outperforming growth different periods of time. Back in the mid to late 80s, we saw growth stocks outperforming for most of the 90s, with the exception of a couple years. Substantially in the late 90s, saw value stocks substantially outperforming in the early 2000s, and we've seen growth stocks outperforming really since 2009. And so we don't know exactly where we are in terms of our sector rotation, and of course we have to take everybody's portfolio different based on their risk tolerance, their cash flow need, their predispositions for or against different investments. But for most of our clients, we're recommending overweighting value stocks, but then also diversifying away from stocks and buying different types of asset classes that will help us if we go into a sustained recession or a sustained declining stock market. We need to have other assets to rely on for cash flow other than our stocks, so we can avoid selling our stocks when they're down temporarily in price. Now, we use value investing, we use examples of buying a business, and we've simplified this, and you may have considered buying a business in your retirement. We have an example of a flower delivery business where the cost to buy the business, $200,000. The book value of the company, which is the assets minus the liabilities, what we own versus what we owe, in this particular case was $200,000 because the company had no debt. So the inventory, the assets were the 5 delivery trucks worth $160,000, inventory of about $10,000, which in our company's case was flowers. And we had a book value of $170,000. So we're actually paying $30,000 over book value to buy this business. And so what we're paying for is effectively this company's ability to produce revenue and essentially profits in the future, and the infrastructure that has already been set up. If you start a business by yourself, there's going to be some work that goes into setting up the infrastructure to be able to generate profits from that business. Now, net income in the first year is $30,000. And as the owner, we decided to keep $24,000 of those profits. So maybe we didn't have any good investment opportunities, so we're going to pay ourselves a dividend. Well, in a growing business, oftentimes we're not going to pay any dividends because we have good growth prospects. We have great investment opportunities for that retained earnings, the money that we made during that year. But if we don't have a lot of earnings, a good fiduciary, a good management team of a company is going to either purchase back stock if it's at a good price through share repurchases, if they believe it's at a good price, or they're going to pay out those dividends to their investors, as they should. So this is how we think of buying stocks. Most individual stocks that we'll buy in a retirement portfolio are far more complex than this simplified example. But this is how we recommend all of our clients think about any investment opportunity. It could be an investment property that you have in retirement, could be your stocks that you buy, could be even your bonds. We look at the valuations of bonds, price relative to the earnings of the coupon payments of those bonds, and also the risk of what's going to happen to the price of those bonds or stocks or real estate investments in the future, and our ability to get back our money while still allowing us to fight inflation over the long run. That's how we look at investments when we're building a retirement portfolio. We mentioned earlier, it's been some very high government spending, unprecedentedly high government spending. And as it turns out, we have seen some great growth in the stock market. As we've stimulated the economy, more people have had more money in their pockets, even though many people have suffered issues with their jobs, lost their jobs in some cases. We're probably going to have to go through a period of austerity and tighten up our belts, which is likely going to mean higher taxes. It's going to mean less government spending, hopefully. Probably going to mean that we're going to need to just have less money to go around. And we're trying to prepare for that and prepare our clients. We do that through running conservative plans and cash flow projections, projecting higher rates of inflation, projecting higher tax rates in the future. And it may mean changing our original plan, might mean taking advantage of Roth conversions now, taking advantage of the current tax code, because some of the opportunities that we have today may be going away. So how do we capitalize on some of these opportunities? Well, first, we definitely want to take advantage of price volatilities. And although it's likely that the market as a whole is expensive right now, it's also likely that there's still some good bargains available. And that's what we believe at the retirement group. So do not try to time the market. Historically, individuals and institutions have been unsuccessful in attempting to do so. A better strategy is to buy good businesses, be a value investor, never overpay for an investment, and plan to hold on to those investments for a period of time. Now, what's the problem with this in a retirement portfolio? Well, unfortunately, once we're retired, we have now this constant cash flow need for most of us once the paychecks stop for, in your case, Chevron. So we have to build a plan that not only incorporates the risk of rising inflation, which is investing in stocks, that's going to help us keep up with inflation, but gives us the ability to pull from our accounts without having to sell stocks when inevitably stocks are down. And even value stocks aren't impervious to stock market corrections. So we have to allocate the portfolio that in such a way that allows us to account for all of these risks that are going on. We don't want to get caught up in herd behavior, and there's a lot of greed in the market right now. I get questions often, especially recently, about cryptocurrency from my clients. They've seen their friends or people that they've heard about make lots of money in cryptocurrency. We've heard, I guess it was last year, about why don't we have the ARC portfolio, the Cathie Woods portfolio in our value model. And a lot of people made a lot of money in a short period of time on those, and fortunately lost a lot of money in a very short period of time as well. So try not to get caught up in the herd, and try not to focus too much on the media either, because a lot of times they will feed off of our two biggest emotions that we go through in investing, which are fear and greed, as it turns out. And unfortunately, investing based on emotional reactions is not always a good idea. And typically it's a terrible idea when it comes to the long-term sustainability of our retirement plan. Try to be patient and not greedy. Unfortunately, as humans, we are typically not very patient, but the best investors over time have that in common. They have patience, but also verify that their original ideas still are standing tall to the reality of the fundamentals of those companies. So a good investment, it might run its course. It could also become a not so good investment if something that we couldn't have predicted, such as political implications. Maybe the company suffered an unpredictable lawsuit of some sort. Good investments can change, but as long as we own them for the right reasons and know that we still own them at a good price, even if there is some bad news that comes out about them, will give us the conviction that we have to hold on to that company or that business as long as we need to grow our capital and keep up with inflation. And then find managers, whether it's the CEO of Berkshire Hathaway, Warren Buffett, or whether it's the portfolio manager of a mutual fund or ETF, find managers that have not only the ability to go to cash, but have a good track record of doing so in times that warrant it. Not that they're timing the market by holding a larger allocation to cash, but if a good value manager is holding cash, it's typically because there just aren't as many bargains available as they would like. and they don't want to be too concentrated in any one company. So they'll just hold cash and wait for better bargains to become available. That typically helps to reduce the risk in a portfolio, as well as allow us to take advantage of some bargains when they become available. Now, what's uncomfortable typically in investing, we found historically, because we're humans, typically the best investments are not always so comfortable to own because they are receiving a lot of negative press at the time. But that's typically when we can find the best bargains. And being a value investor, we're going to have to go through periods of discomfort where we may be contrarian. We may not be investing how the majority is investing. And it's very difficult to stick to your guns, stick to your religion in this time frame. But historically, it helps to look at what great value managers have done. And sometimes they've underperformed the market in short periods of time. What the average investor does is then move from that manager to another manager that might have just outperformed the market. This is typically not a good idea, chasing returns like this. So just by having not only good fundamentals in our philosophy for investing, but revisiting and having conviction. This is why it's important to have a good relationship with your financial advisor so they can give you the education that you need to have that conviction and not get too impatient with the investment strategy, is going to have your money growing better over the long run. Okay, so we've gone through some examples of value philosophy, and as it turns out, history has shown that the best time to retire are when stocks are on sale. And in addition to that, the best time to retire is when interest rates are low, which unfortunately is not a comfortable time to retire because we can't generate as much yield typically from our fixed income holdings. But we are still in a very low interest rate environment historically, even though we've seen interest rates go up a little bit in the last few months. The inflation risk, right now, dividends pay more than bonds. So we've been a little bit more allocated to higher interest paying stocks, also known as dividend paying, and even maybe some preferred stocks in that case, because we haven't been able to generate as much yield from bonds. We've also started using, for some of our clients, typical different types of annuities, not the old annuities that have high costs and where you're giving up your principal to get an income stream, but bond alternatives where we can protect our principal while still allowing some type of participation in the stock market. And we found these to be good, in many cases, alternatives to bonds that have a risk of interest rates going up and the value of those bond or fixed income investments eroding. So that could be something to consider and talk to your advisor about, is how you might be able to utilize these insurance investments to not have to have so darn much in bonds in your retirement portfolio when the traditional method might be a 60-40 mix of stocks and bonds. That's a lot of money in bonds that may have a big risk to your principal going forward while not compensating you much for that risk that you're taking. And then just try to understand that emotions drive all of our decisions as humans. And by understanding those emotions, we can help to manage those emotions and not make decisions based on our emotions, but more in line with our long-term best interests. Unfortunately, 74% of Americans over the age of 50 do not have a written plan for their retirement. This is not acceptable, folks. There's a variety of companies, including the retirement group, that will write one up for you for free, complimentary. It does, of course, cost some of your time, so I guess it's not completely free, but we're very confident it'll be a good investment of your time if you put a plan together with us. Allow us to present it to you, whether in a web meeting or in-person meeting, and point out what we believe to be the most important considerations given your circumstances. And everybody's different on this, but things to focus on now to maximize what you walk away from Chevron with, minimize your total taxes over your lifetime, and have the biggest retirement paycheck possible so that you can live as comfortably as possible for whatever your values are and objectives are after you leave Chevron. Some of our clients have told us what is important to them about their advisor and their relationship, and we've tried to build our business upon those values. Some of those being understanding the Chevron retirement plans and having lots of clients from Chevron so they can have confidence we're not going to let them make any mistakes. Having a reasonable cost of our service. Of course, nobody wants to have the most expensive advisor, but you probably don't want to have the cheapest advisor either, depending on what you're looking for from that relationship. And almost every one of our clients is paying less than 1% a year, but there's a variety of different determinants of how much the cost is going to be, such as how much you invest with us, how much company stock you keep, how many cash equivalents you keep, how aggressive the portfolio is. And so we talked to you about how to build that portfolio, and we want to hear from you on what's important about that. And typically reducing fees is very important, but it's not always the most important aspect of the portfolio, such as the communication and the growth net after the fees, which is what most of our clients tell us. And what other value are you looking for from this relationship? Most of our clients expect that we have a team that's behind us, so that if something happens to me, if I take a vacation, if I leave the industry, we have a good roster of individuals to fall in line and take care of them if they need to. But we also have a team that is helping with the analysis of the investments and keeping myself and Patrick and our other representatives informed about why we're investing the way that we are, and helping take some of the heavy lifting off of our plate so that we can be better at communicating with our clients. Not every advisor group set up like that. User-friendly website. We use Charles Schwab as a custodian. Very good website for research capabilities and pretty easy to understand statements, at least in my opinion. Also help with the distribution strategy, which is where to pull from and how to be tax efficient when we're creating cash flow from our portfolio. We find that to be pretty important. And making sure that we not only have a detailed financial analysis, but we don't charge for it. And then we update it periodically throughout your retirement to account for the unexpected changes that we could not have necessarily predicted in the beginning. So none of those might be important to you, but we want to know what's important to you. And we'll tell you, honestly, if we don't think it's going to be a good fit. If you have an expectation for communication that we cannot keep up with, we're going to tell you about it ahead of time, because the last thing we want is a bad reputation within the Chevron community. So give us an opportunity to earn your business, at least put a plan together for you. And we're very confident it'll be a good investment of time. And even if you don't do any business with us, we're very confident you'll at least have some good things to say about us among your coworkers at Chevron before you leave the company. If you'd like to schedule a meeting with myself or Patrick or any one of our Chevron focused advisors, you can take a picture of the QR code at the bottom here and get on one of our calendars. You can email us at info@theretirementgroup.com. You can call us at the home office at 800-900-5867. And I also encourage everybody to follow us on the LinkedIn page if you're not doing so already, because there's a whole host of different topics related to Chevron retirement strategies that we believe you'll probably find some value in. So with that, we're going to wrap it up for today, but I want to thank everybody for your time this afternoon. Patrick, if there's any questions on today's call, give people an opportunity to ask them so we can hopefully answer them.
Yeah, there are a few questions, Tyson. So let's get right to them. One is, even though I may have a plan for retirement, should I have a backup plan? The main concern here is inflation and its effect on my pension at Chevron. I'm not sure how to address that moving forward.
Yeah, well, it depends on which option you take. Number one, on your pension, we talked a lot about the lump sum interest rates, but the annuity option still needs to be considered. And even in the low interest rate environment we're in today, might be appropriate for you depending on a variety of factors. But inflation is going to severely impact the purchasing power of your annuity, because even as the cost of living goes up in retirement, if you take the annuity on your Chevron pension, your income is not going to go up, at least on that piece of your income. So inflation has its risks on the annuity option, but it also has risks on the lump sum, because inflation and interest rates are inherently correlated. As we see inflation start to go higher, and we've already seen this just in the last year, interest rates typically follow suit and start to go up. And if you haven't retired yet or taken your lump sum, this higher inflation environment that we're entering into is likely going to reduce and erode the value of your lump sum. And if you're not ready to retire yet, or you can't afford to, you don't have a whole lot of control over that, other than preparing for having less money in your overall plan, which you can save more now, might be advisable. You can plan to spend less in retirement, work on your budget and figuring out what your current expenses are, and try to cut some things out that might not be sacrificing much of your lifestyle if you do it. Or you might need to work longer, whether at Chevron or somewhere else, maybe just for a few years, to have more money than you will probably need because of all these unpredictable circumstances. We prefer to have a nice buffer on the retirement plan because we cannot predict how long you're going to live or what tax rates will be in 20 years or where inflation will be. So stress test the plan, retire with more than you need. The best retirement plan is to write a hot check on your deathbed, some would say. But if there are some people that you're looking to help out through retirement or leave some money to after retirement, those also need to be considered in the estate plan that we put together. So hopefully that added some insight into the question.
Yeah, for sure. Here's another good question. If inflation is such a huge factor on my pension payout, assuming that, that person takes the lump sum, of course, how far out can I plan for retirement? And is it easier to plan for a retirement the closer you get to retirement, or should I be planning a few years ahead?
It's never too early to start planning for retirement. It's good to know how your benefits work because there's a lot of things you can do in your 401k that will allow you to have more money when you retire. So that would be one reason to not wait till the last minute or defer that. Fortunately, it's not a popular thing to spend time on, as it turns out, for most people. Statistically, we spend more time planning our vacations than we do our own retirements, which is really the longest vacation of your life, is one way to think of it. But the closer you get, at least you'll have more power to choose the timing of your retirement, which is important, the interest rate environment and which option you'll take, which, the option on your pension might also be a function of when you're retiring and where interest rates are. But I guess my advice is put the plan together now. There's no reason not to. There's a variety of companies that'll do it for you for free. You'll at least have an idea of where you're going so you can build a better path on how to get there.
Yeah, I completely agree. And as you mentioned, this is a service that we offer as a complimentary advantage for you, if you will, to find out if you are looking for a partner in retirement, who might you want to work with. And so this is certainly a way for us to get to know you a little bit better. And since we do it for free, there's really no reason not to do it. But certainly, if you consider the current economic environment as an addition to this interest rate issue and how it correlates to your pension, this would be one of the benefactors of having several cash flow analysis ran on different rates of return on hypothetically what you're going to earn in retirement and what inflation might actually be like, or more importantly, for some folks, how much they're going to spend in things that they can't control, like healthcare costs 10, 15, and 20 years down the road. So any of these things we can model in a cash flow analysis to kind of fine tune it for your personal needs. And so if you're interested in doing that, please reach out to us at 800-900-5867. If you have specific questions that we did not address today, please email us at info@theretirementgroup.com. And for that, we'll wrap it up for this afternoon. We appreciate your time today, and we hope you found value from spending a few minutes with us. We'll catch you next time, folks. Take care.
Thank you, folks.